Will housing ever become affordable again? Most answers sound comforting. More supply, lower rates, better policy. But the math doesn't agree. Home prices didn't just rise, they detached from income. Supply didn't just slow, it fell years behind population growth. And even if we fixed everything people argue about, the gap wouldn't close fast enough. So before asking what policy will fix housing, we need to ask a harder question. What would actually have to change mathematically for affordability to return? Because once you run the numbers, the answer isn't hopeful, it's brutal.
The income gap no one wants to do the math on. So let's start with the numbers, because this debate only makes sense if we're honest about the math. For most of modern American history, home prices and household incomes moved together. Not perfectly, not smoothly, but within a range that made ownership achievable over time. That relationship broke after 2020. Between 2019 and the peak, national home prices rose roughly 40 to 45%, depending on the index. Over the same period, median household income rose closer to 15 to 20%. That gap isn't cosmetic, it's structural. Because housing affordability isn't determined by prices alone, it's determined by monthly payment relative to income. And that's where the math turns unforgiving. A median-priced home today requires a payment that consumes over 40% of median household income in many metros. Historically, that number hovered closer to 25 to 30%. That difference isn't a lifestyle adjustment. It's the difference between qualifying and not qualifying. Even if prices stopped rising tomorrow, affordability wouldn't reset, because incomes would still be too far behind. To restore the pre-2020 affordability balance, one of three things has to happen. Incomes surge far faster than historical norms, home prices fall meaningfully in real terms, or households accept permanently higher debt burdens.
Each of those options has consequences, and none of them are politically or economically easy. Wage growth strong enough to close this gap would require productivity gains the U.S. hasn't seen in decades. Price declines large enough to restore affordability would directly hit the balance sheets of existing homeowners. And higher debt burdens push households into financial fragility, which eventually feeds back into the broader economy. This is why waiting it out doesn't work. Time alone doesn't fix a broken ratio. If incomes and prices grow at similar rates from here, the gap simply stays locked in. Affordability doesn't come back by accident. It only returns if something forces the numbers to realign. And that's the core problem, because most housing conversations assume affordability is a cycle, that prices rise, then fall, then normalize. But what we're dealing with now isn't cyclical. It's a reset to a higher baseline, one that assumes a different buyer, a different income profile, and a different tolerance for debt. In the next chapter, we'll look at the second constraint that makes this gap so hard to close: population growth colliding with a housing supply that's been lagging for over a decade. That's where the math gets even less forgiving.
Population didn't pause. Housing did. If income were the only problem, housing affordability would still be hard, but not impossible. Historically, when prices ran ahead of wages, supply eventually caught up. What broke this time is that the income gap collided with something far more rigid: a decade-long housing shortage. The U.S. didn't stop adding people, it stopped adding homes. After the 2008 crash, home building collapsed and never fully recovered. From 2009 through the late 2010s, housing starts averaged roughly 1.1 to 1.2 million units per year. That might sound like a lot, but it wasn't enough. Over the same period, household formation averaged closer to 1.4 to 1.6 million households per year, depending on the cycle. Some years it was higher. That gap, a few 100,000 units annually, doesn't feel dramatic in isolation, but compounded over time it becomes decisive. By most estimates from housing economists and institutions like Freddie Mac, the cumulative underbuilding since the post-2008 period now totals between 3 and 5 million homes nationwide. That's not a temporary mismatch. That's a structural deficit baked into the market. And unlike other goods, housing can't respond quickly once that deficit exists. A new factory can scale production in months. Housing projects take years. Land has to be zoned, permits approved, financing secured, labor hired, materials sourced.
So, when demand surged after 2020, the system had no slack. Household formation rebounded sharply. Remote work unlocked geographic mobility. Average household sizes fell, meaning more units were needed per capita, not fewer. Yet supply was constrained on every front. Zoning restrictions limited density. Construction labor was already short before the pandemic. Material costs spiked. And higher interest rates later tightened development financing. The result wasn't just higher prices, it was competition for scarcity. When there aren't enough homes, prices don't fall simply because affordability breaks. They stabilize at the highest level the marginal buyer can still support. And that marginal buyer is rarely the median income household. In many markets, it's a dual-income professional household stretching leverage, or an existing homeowner rolling accumulated equity forward, or an investor evaluating yield, not shelter. That's why worsening affordability didn't trigger a price collapse, it triggered exclusion. First-time buyers were pushed out first. Lower-income households followed. Younger households delayed ownership or exited expensive regions entirely. Population didn't disappear, it redistributed. Sunbelt metros absorbed demand faster than they could build. Coastal cities saw fewer transactions, but supply tightened even further. Different dynamics, same underlying shortage. And this is where just build more housing arguments hit reality. Even in years when housing starts climbed back toward 1.5 million units, that pace barely matches current household formation and does nothing to erase a multi-million unit deficit. To close the gap meaningfully, the U.S. would need years of sustained above-trend construction through economic slowdowns, political resistance, and tight credit cycles. That's not how housing has ever worked historically. Builders don't build for national affordability goals. They build for risk-adjusted returns. When uncertainty rises, supply pulls back, even if prices stay high, and every pullback resets the clock. So when people ask whether housing will become affordable again, they're really asking whether supply can catch up fast enough to matter. And based on the math, so far, it hasn't. Because the shortage isn't just behind us. In many regions, it's still growing. In the next chapter, we'll look at why even when supply does recover, it doesn't automatically translate into affordability, and why the homes being built often don't match the incomes that need them most. Why even new supply doesn't restore affordability. At this point, the argument usually shifts to a single line. We just need to build more. But that assumes all supply solves the same problem. It doesn't, because the housing being added today is not designed for the median income household. It's designed for financial viability in a high-cost system. After 2020, the cost structure of building changed dramatically. Land prices rose, labor shortages intensified, material costs surged and never fully came back down. Financing became more expensive and more restrictive. That reset the break-even price for new construction. In many metros, it's no longer economical to build entry-level homes, not because developers prefer luxury, but because affordable doesn't pencil. If construction costs alone push a unit's all-in cost above what a median household can support, supply can increase without affordability improving. And that's exactly what we're seeing. New homes skew larger. New apartments skew higher end, and even starter homes now enter the market at prices that assume above median incomes. This creates a mismatch. Households priced out of new construction don't suddenly gain access to older housing because older homes don't filter down fast enough when turnover slows.
And turnover is still constrained.
Homeowners with low fixed-rate mortgages don't move. That locks existing supply in place, which means new construction doesn't relieve pressure. It competes with scarcity. The result is a market where supply grows but access doesn't. And there's another layer most discussions avoid. When supply finally responds, it often arrives in the wrong places. Permitting is easier where demand is already strong. Land is available where jobs aren't growing. Infrastructure lags where population surges. So units get built, just not where affordability is under the most pressure. This is why national housing numbers can look improving while household-level affordability keeps deteriorating. Supply is a necessary condition. It's not a sufficient one. Without alignment between income levels, location, and price point, building more simply reshapes who gets housed, not how affordable housing becomes. And that leads to a hard conclusion. Even in a best-case building scenario, affordability doesn't snap back. It grinds, slowly, unevenly, and with long delays. In the next chapter, we'll quantify just how long that adjustment would take and why waiting for the market to fix itself means locking out an entire generation in the meantime.
The math behind affordable again doesn't work. So let's stop talking in abstractions and run the numbers directly. Historically, housing affordability in the U.S. worked around a simple anchor: a median home priced at roughly 3 to 3.5 times median household income. At that ratio, ownership was difficult but achievable over time. Today, that ratio is broken. The median U.S. home price now sits around 5 to 6 times median household income, depending on the metro. In many large cities, it's higher. That alone would be manageable if financing were cheap, but it isn't. At current mortgage rates, the monthly payment on a median-priced home absorbs 40 to 45% of median household income in many markets. That's before taxes, insurance, and maintenance. Lenders typically consider 28 to 30% the upper bound for sustainable housing costs. That gap is the affordability crisis. Now here's where the math becomes unforgiving. Let's assume an optimistic scenario. Home prices stop rising entirely. No crash, no growth, just flat. To restore the historical affordability ratio without price declines, median household income would need to rise by roughly 30 to 35% in real terms. That doesn't happen quickly. Over the past 30 years, real median income growth has averaged closer to 1% annually. At that pace, closing a 30% gap takes decades. Now flip the assumption. Suppose incomes grow at a strong 3% real rate, sustained, something the U.S. hasn't achieved consistently outside of short periods. Even then, it takes 10+ years to restore balance, assuming prices don't rise at all during that time. That's the best case. Now consider the price side. To restore affordability at today's income levels, home prices would need to fall by roughly 20 to 25% nationally, and much more in high-cost metros. That's not a minor correction. That's a political and financial shock. Roughly 2/3 of U.S. households are homeowners. For most of them, housing represents their largest asset. A 20% price decline doesn't just help buyers, it wipes out trillions in household equity. That's why broad-based price declines face resistance at every level: monetary policy, fiscal policy, and local politics. So what about building our way out? To close the estimated 3 to 5 million unit housing shortfall, the U.S. would need to build well above long-term averages for many consecutive years.
Historically, housing starts average around 1.5 million units per year. To meaningfully close the gap, estimates suggest something closer to 2 million plus annually, sustained, not during a boom, but through slowdowns and recessions. That's never happened. And even if it did, those homes wouldn't instantly be affordable. They'd arrive gradually, unevenly, and often at price points above median affordability. So when people ask, will housing ever become affordable again? The math doesn't say no because of pessimism. It says no because every path back requires something extreme: unusually fast income growth, politically painful price declines, or a decade plus of aggressive, uninterrupted building. And none of those are the baseline assumption for the U.S. economy. Which brings us to the uncomfortable reality. Affordability doesn't return by drift. It returns only through force: economic, political, or demographic. In the next chapter, we'll look at what actually happens when affordability doesn't come back, how households adapt, who gets locked out permanently, and why this reshapes the housing market even without a crash. What happens when affordability never returns? When housing doesn't become affordable again, the market doesn't collapse, it adapts. And that adaptation is already visible. Homeownership stops being a broad middle-class milestone and becomes a timing-based advantage. Who you are matters less than when you entered. Households that bought before the surge are insulated. Their payments are fixed. Inflation quietly erodes their real housing costs every year. Everyone else faces a different reality. First-time buyers don't disappear, they delay. They rent longer, they double up, they move farther from job centers, or they exit high-cost regions entirely. That changes demand, but it doesn't relieve pressure. Because delayed buyers don't vanish, they accumulate in the system. By their 30s and 40s, many are still competing for a limited pool of entry-level homes, often with more savings, higher incomes, and fewer options. This pushes the starter home further out of reach, even as overall transaction volume stays low. Meanwhile, the rental market absorbs the pressure. Higher barriers to ownership increase rental demand. That supports higher rents, even in slowing economies, which makes saving for a down payment even harder. This is how affordability becomes self-reinforcing. Rent inflation limits savings. Limited savings delay ownership. Delayed ownership increases rental demand. The market doesn't reset, it tightens. And there's a broader economic cost. Housing is the foundation of labor mobility. When people can't afford to move, they stay put. They turn down better jobs in other regions. They optimize careers around housing, not opportunity. Over time, this drags on productivity growth, quietly, structurally, and without a single headline moment. There's also a demographic consequence. Household formation slows. Marriage and family formation are delayed. Birth rates decline. These aren't cultural shifts alone, they're affordability outcomes. When stable housing requires extreme financial commitment, people postpone life decisions, sometimes permanently. And here's the part that often gets missed. Markets adjust expectations. If younger households stop believing ownership is attainable, behavior changes. Long-term renting becomes normalized. Political pressure shifts from affordability to stability. That doesn't fix the system, it locks it in. Affordability doesn't have to return for the market to function. It only has to function for those already inside. Which brings us to the final question. If affordability doesn't come back naturally, and if every mathematical path back is politically painful, what would a real solution actually require? That's where we're going next. The only ways affordability comes back. If housing ever becomes affordable again, it won't be because the market drifted there naturally. It will be because something forced the numbers to realign. There are only a few mechanisms that can do that. The first is income growth that meaningfully outpaces housing costs, not temporarily, sustained. That would require productivity gains well above recent history, combined with wage growth that flows to the middle, not just the top. It's possible in theory, but it's not the baseline assumption for the U.S. economy. The second is real price declines, not nominal stagnation, not prices up less than inflation, actual declines large enough to restore historical income-to-price ratios. That path is faster and more disruptive. Price declines redistribute access, but they also redistribute losses. Household balance sheets take a hit, local tax bases shrink, political resistance intensifies. That's why broad-based price corrections are rarely managed. They happen when something breaks. The third is aggressive, sustained overbuilding. Not a boom, not a few good years. A decade of building well above historical averages across regions, price points, and cycles, including during downturns. That would require zoning reform, infrastructure investment, labor expansion, and political alignment at levels the U.S. has rarely achieved simultaneously. And even then, affordability would return slowly. There's a fourth path people don't like to talk about. Affordability can return if demand weakens structurally. Lower population growth, lower household formation, out-migration from high-cost regions. That doesn't feel like a solution, because it isn't one. It's an adjustment through constraint. What all these paths have in common is cost, economic cost, political cost, social cost, which is why none of them are pursued aggressively. So the honest answer to the question isn't that housing will never become affordable again. It's that affordability doesn't come back by default. It returns only if the country chooses a path that forces the math to change and accepts the consequences that come with it. Until then, the market will keep doing what it's already doing, functioning, excluding, and quietly reshaping who gets access. So no, housing didn't become unaffordable because of one bad year or one bad policy. It became unaffordable because access broke slowly, and we kept treating it like a temporary problem. Housing is just where the math finally stopped working, but it won't be the last place.
If this kind of analysis helps you see the system more clearly, consider subscribing. This channel isn't about predicting crashes or chasing headlines. It's about understanding how access breaks, quietly, structurally, and what that means over time. The next video continues this thread, looking at who actually benefits when housing stops working and why it's rarely the people you think. Thanks for watching. I'll see you in the next one.